Picture this. It's late 2025. The crypto world is just holding its breath. Bitcoin, which had been flying high at nearly $126,000, is now in an absolute freefall. So, what on earth happened? Let's unpack the anatomy of this monster crash.
$1.2 trillion. Yeah, you heard that right. That's the insane amount of value that was just, poof, erased from the digital asset market. A number so huge it's honestly hard to even wrap your head around. And the truly terrifying part? The speed. This wasn't some slow leak. This was a catastrophic, violent collapse that happened in what felt like the blink of an eye. An entire year's worth of gains. Just gone. Wiped out in about a month and a half. So how does something like this even happen? Well, it wasn't one single thing. It was a perfect storm, a brutal, nasty collision of three different forces all hitting at the same time. Let's break them down, starting with the one that, believe it or not, didn't even start in crypto. So, the first domino to fall wasn't on some crypto exchange. Nope. It was in Washington, D.C. A government shutdown suddenly plunged the entire global financial system into a state of total confusion. And honestly, this analogy just nails it. The Federal Reserve, right, the people who are supposed to be steering this giant global economy, were suddenly flying completely blind. And let me tell you, when the pilot can't see, the passengers, and that's all of us, the investors, we start to freak out. This is really where the chaos kicked into high gear. The little bit of data that did manage to get out was just all over the place. On one hand, you had strong job numbers, which meant the Fed was probably going to keep interest rates high, and that's bad news for risky stuff like Bitcoin. But then on the other hand, unemployment was going up, which screams recession. And to top it all off, the next big jobs report just canceled. You couldn't invent a worse environment for investors. It was pure crippling uncertainty.
Okay, so here's the bottom line, that the thing you gotta get. The market's entire game plan for the year was built on one idea. The Fed would start cutting interest rates, making money cheap again. And then, suddenly, violently, that hope was just ripped away. It was replaced by this grim new reality of higher for longer.
So just as the big picture was getting super foggy and scary, the absolute last thing the market needed was a shock from inside its own house. But, well, that's exactly what it got.
And that brings us to ingredient number 2. This one came from within the crypto world itself. It was the awakening of a ghost from Bitcoin's past, a legendary, super early investor who all of a sudden decided, you know what, I'm out.
11,000 Bitcoin. Now, this wasn't just any wallet. This was a wallet linked to Owen Gunden, a guy who started stacking sats way back in 2011. We're talking about ancient coins from the Satoshi Era that almost never, ever move. And to put that into perspective for you, at the time, that stash of Bitcoin was worth $1.3 billion. When a holder of that size, with that kind of legendary status, decides to sell everything, the market doesn't just pay attention. It starts to shake. And he didn't just rip the Band-Aid off and dump it all at once. Oh no. This was a slow, systematic, month-long execution. Every single time the market tried to find some support, another wave of his coins would hit, just crushing any buy orders and pushing the price down, down, down. And it all ended with that final massive transfer that just completely emptied his wallet. This move triggered a crazy psychological effect called mimetic capitulation. It's a fancy term, but the idea is super simple. When an original gangster, a true OG of Bitcoin, sells his entire bag, what do you think everyone else does? They think, oh my God, what does he know that I don't? And just like that, panic becomes the most rational thing to do. A sell-off turns into a full-blown stampede for the exits. But see, that one guy selling, he just lit the match. The real inferno, the gasoline that was about to explode, was all the new money that Wall Street had poured into crypto over the past year. Which brings us right to the third and final ingredient of this whole disaster. The very tools that made it so easy for Wall Street to get into Bitcoin, those spot ETFs, well, they became the high-speed express lane for them to get the hell out. I mean, just look at this reversal. It was absolutely breathtaking. After months and months of money flowing in, pushing prices to new all-time highs, the trend flipped with just shocking speed. In a single week in November, more than $3 billion flooded these funds. It turns out that the so-called smart money might have had the weakest hands of them all. And to add even more anxiety to the fire, you had the whole MicroStrategy situation. You know their strategy: borrow tons of money to buy Bitcoin. It's brilliant when the market's going up, but in a crash, it becomes a massive risk. As the price was falling, their newest purchases were deep underwater. And this sparked fears of a death spiral. A falling Bitcoin price hurts their stock, which makes it harder for them to borrow money, which could force them to sell Bitcoin, which pushes the price down even further. You see the problem.
So let's recap. We've got a confusing macro picture, an OG whale cashing out completely, and Wall Street running for the exits. Where does that leave the regular investor? Well, it leaves them in a state of absolute pure panic. The Crypto Fear and Greed Index, which is basically a heart monitor for the market, plunged to a score of just 10 out of 100. Let me be clear. These are extreme fear levels we haven't seen since the absolute darkest days of past crypto winters. The market wasn't just a little nervous, it was completely and utterly terrified.
So the big question is, where do we go from here? Right now, analysts are basically looking at three possible paths. A quick, sharp V-shaped recovery? That seems pretty unlikely given how much damage was done. What's more probable is either a spring thaw, a really slow, painful, sideways grind while the market heals, or a full-on ice age, which would be a long, drawn-out bear market that could last well into 2027. What happens next really depends on the Fed. And all of this brings us to the final and most important question for anyone watching this unfold. When you're standing in the middle of the wreckage, surrounded by all this panic, the real challenge is figuring out how to tell the difference between danger and opportunity. Because, as the old saying goes, the time of maximum fear is also the time of maximum opportunity. So the trillion-dollar question is this time any different?